looked like the numbers stopped increasing for now. So I think we'll get started here. Hi, everyone. Thanks for joining us today. My name is Kevin Woodworth, and with me today is Hannah Mendicino, who I'll have introduce herself in just a minute. The focus of today's presentation is around financial planning strategies for young professionals. Now, I'm sure there's a wide range of knowledge and experience from the people listening in today. So we're going to try to make it not too simple and also not too complicated. A couple other things, and then I promise I'll let Hannah speak here. So for those of you listening, you might be wondering, why would an accounting firm be talking about financial planning strategies? And at DKB, we believe working with someone regarding their taxes is much more than simply just preparing their tax return. There's so much more value you can get out of the process, which can then lead to talking to clients about these financial planning matters. I do want to state we do not manage assets here, and our goal is to remain independent and objective while helping clients build their plan for the future. So I'll shut up now, and I'll let Hannah introduce herself and talk a little bit more about how we serve our clients.
Thanks, Kevin. So I'm Hannah Mendicino. I've been at DKB for about 4 years now. So I work primarily with high net worth individuals, preparing tax returns, and in the financial planning department. So a little bit about my background. So I was raised by a single mom of 3 kids. So she was never really flushed with money. And ever since I was little, she kind of drilled it in my brain to always be financially independent. So with that, I've been maxing out my Roth IRA since I was 18. I bought my first house when I was 23, and I've been able to develop good financial habits while still splurging on the things that I love. I think that in your everyday life and in school, they fail to educate you on how to file a tax return, how to manage money. And what we like to do for young professionals is to work with them to educate them, guide them through financial questions, decision making, whether it be being an accountability factor, an education source, or helping them develop a budget.
So I think there's a few different topics that we want to touch on today. And Stephanie, if you kind of hit forward a couple slides here, we'll kind of address the topics here. So the first one is the importance of starting early. So as I stated earlier, today is meant to focus on young professionals. And how do you define a young professional? I think that varies. So it could mean a 22-year-old just coming out of college, starting their first real job, or it could mean someone in their early 30s that's worked for a number of years, but still has a pretty long runway before retirement. So with that said, the key point that we want to emphasize here is the importance of starting early. So it might seem obvious that the earlier you start saving and investing, the more time you have for that money to grow. The added benefit in doing this is what's called compounding. So again, for those of you that are kind of new to all this, another way to put this is you make money on your money. And the way that the compounding will work, especially in, say, a retirement account, like a 401k, is even greater, because in a 401k, and we'll get to this in a little bit when we talk about the basics of investing, the 401k is a tax deferred account. So what that means is the earnings and everything inside the account will grow tax-free all the way up until you get to retirement and you start to take distributions out of the account. So Hannah has an example that she's gonna walk you through here that shows you the importance of starting early.
Okay, so this next chart shows the difference of starting early or starting in 10 years. So as you can see, this gray line represents Susan. This blue line represents Chris. So they both start investing $5,000 each year at the age of 25. So Susan kind of stops investing after 10 years, and then Chris keeps on going until he's 65. Then this kind of gray, blackish, charcoal colored line. That is Bill. So he invests and he begins when he's 35 and he invests all the way till he's 65. So as you can see, even though Susan stopped, she only invested for 10 years, she still ends up with more money than Bill. So that's the power of compounding. So if you start early, your money works itself. So you make money on your money. So that's why we just think it's so important to start when you're young and even if it's a little bit.
Yeah, so obviously in the example here, we're using an amount of 5,000 a year. And some of you that are on this call might be kind of starting out your career and you might say to yourself, $5,000 a year, how am I supposed to manage that? And we'll get into it in a little bit. A big component of all of this kind of revolves around budgeting, but you can, as Hannah mentioned, the impact of just doing it for 10 years, but doing it earlier and letting that money just grow and compound is a huge deal when you look at someone that starts later on and does it for a very long period of time and still doesn't end up with as much money. Obviously, Chris in this example has the right approach, and I mean, obviously, everybody maybe can't do this, but doing it all the way to retirement just makes it look that much better. So compounding is a very big deal, and starting early is a very big deal. So a couple of the questions that came in ahead of time, which I'll go through right now, is kind of one, just basic, should I put money into my 401k? And I think the answer to that is it's a great start. And there's a few things that you want to consider when talking about putting money into a 401k is, and it kind of goes back to what I said earlier, is first you need to be able to develop and kind of come up with a budget, because without that, you're not going to be able to make the decisions that you need to make as it relates to various investing and saving. So I'll get back to how much money to put into a 401k in a second. So another question that came through was, what is the best way to develop and stick to a monthly budget? And I'll let Hannah kind of speak in a second here, but what I would say is there's a couple things as it relates to a budget. One, it needs to be practical. It needs to be realistic. So if you're bringing in, I'll just make up some numbers here, $2,000 a month, and you have expenses going out of $2,200, clearly that does not work, and you need to refine what that budget is. So it needs to be practical. The other thing that is you need to hold yourself accountable. If you come up with a budget and you just don't even think about it or care about it and don't track it or anything like that, then how do you really know what you're spending your money on and how can you actually stick to that budget? So there's plenty of tools out there that can help with this. I mean, you could do something as simple as using an Excel document, but there's a lot of different apps and things out there that you can use to kind of track your various expenses. I mean, I know a lot of people put a lot of their expenses on a credit card maybe, and you can get reports that show what you spent and where you spent it. But I think those are the two biggest things, being realistic about it and also being able to hold yourself accountable. Anything you want to add there, Hannah?
Yeah, I think a good rule of thumb when you're starting out budgeting is kind of look at it percentage wise. So maybe put 50% of your income towards bills like groceries, mortgage, rent. So if you can kind of stick in that 50% and then 30% is kind of splurging on things that you like to do or trips you like to take or experiences, different things like that. And then the last 20% just kind of focus on saving that. So if you kind of build into your budget something around those parameters, it's going to be very helpful. Um, and then
Yeah, so as Hannah was saying, I mean, there's lots of different kind of what they call a rule of thumb that are out there, and kind of that one that Hannah just mentioned is obviously one of them. So that kind of takes us back to that first question that I mentioned was, should I put money into my 401k? So I think once you get through the budgeting aspect of things and you know kind of what you have to be able to save, then you can consider putting money into a 401k. And again, we'll get to some of this when we get to the basics of investing here in a second. But one thing that I would say is, as it relates to putting money into a 401k, is that a lot of, employers will give you what's called an employer match. So what that means is they'll contribute up to a certain percentage as long as you're putting money away as well. So what you want to make sure you're doing, and again, this might seem basic, but if the company's willing to match 3%, then you want to be putting in at least that much so you get that 3% match by the company. That's pretty much a no-brainer, because that's going to be, in essence, free money that's going into your retirement account. So you want to consider that. And then there's other things to think about that we'll get into here in a second that can add a little bit, maybe a little bit more complexity to it. So with that said, I guess we'll move a little bit into the basics of investing, and I'll let Hannah kick that off and kind of go over some of the things that we want to address here.
Okay, so when thinking of basics of investing, there's kind of two things to look at. What are the different types of investment vehicles? And then when you are investing, how do you invest that? So what does your asset allocation look like? So with the different types of investment vehicles, there's stuff out there like savings accounts, Roth IRAs, 401ks, brokerage accounts, stuff like that. So basically, how a brokerage account works is you invest after tax dollars. If it grows, you take it out. You get taxed on it, short-term capital gains, long-term capital gains, depending on how long you've held it. And then there's also stuff that's more retirement based. So Roth IRAs, 401ks. So the main difference between an IRA and a 401k is an IRA typically is funded by you, where the 401k is usually under like a business type of plan. So one of our favorite investment vehicles is definitely the Roth IRA. So how this kind of works is you put in after tax dollars, it goes in there, it grows, and then anything you take out on that afterwards is tax free. So all growth, all principal, anything that you put into it, you take it out and it's tax free. The only thing is it is a retirement account, so there also are some rules within that, and you do have to wait till you're 59 and a half to take out the earnings.
Yeah, so to that point that Hannah just said, when you're putting money into a retirement account, the idea obviously is to put it in the account and then not touch it until retirement. And as Hannah just alluded to, if you take it out before age 59 and a half, you obviously would have to pay tax on it. There's an additional penalty. So, that we would definitely advise against doing that. We also understand that there's always situations where maybe something catastrophic happens and you have to pull out money, but that would be an absolute last resort. And to that point, I know Hannah mentioned the Roth IRA, and anyone that's listening that knows us, we're big advocates of the Roth IRA. Dennis Stein, who we work with as well, I'm sure he'll appreciate us kind of talking about the Roth IRA, because he is also a big advocate. But the Roth is an extremely powerful vehicle because, as Hannah was saying, when you contribute to a Roth, you use post-tax dollars. So what that means is, unlike where you have a 401k, when you make contributions, it's a pre-tax contribution, so that essentially lowers your taxable income in the given year. Whereas with a Roth, you use post-tax dollars, so you've already paid tax. So once that money is inside the Roth IRA, it's completely tax-free from then on, because it's a retirement account, so the money grows tax-free. And then the beauty of the Roth is then when you ultimately take money out of the Roth, way down the road, it's also tax-free. So one of the things that we really kind of strive for when we're looking at kind of the different assets that someone might have is I always kind of like to use the terminology of buckets. So you've got these different buckets that you can invest in. And as Hannah was saying, you've got your kind of non-qualified account, which is kind of your brokerage account, which you're putting after tax dollars into, and the income that you generate inside that account, you do pay tax on as you earn it. And then there's your qualified accounts, which is retirement accounts like your 401k or the Roth IRA. But the difference between the 401k and the Roth IRA is one is you pay tax when you take distributions out, which is the 401k, versus your Roth IRA, you're not. So we like to look at these different buckets and say, okay, how can we strategically fill these different buckets to, in a way, put us in a great position when it comes to retirement time, so you're not having to pay astronomical taxes or anything like that, because we're accountants. So we think tax is a big component of your overall plan. So we want to think about that and be strategic. I think what it also does, and we did get a question come in around this topic, is, okay, well, what if I need money while I'm working still and in my career, because things always come up. So there's a couple of things that I would touch on there. Is one, I mean, a lot of people, I'm sure, have heard that kind of an emergency fund is something that you want to have. And there's different types of numbers that get thrown out there of kind of 3 months worth of salary or anything like that to be able to, in case there is something that happens and your roof starts leaking or anything like that. So being able to have funds in the necessary bucket so you're not having to pull out from, say, your 401k is very important in all of this. So we definitely want to look at that and be able to say, how are we going to be able to, one, save for retirement, but also know that we could have issues, I mean, right now, that we would need money for. One other thing I'll make a comment on about the Roth is, as we were talking about, this is kind of a last resort. You don't want to pull money out of these accounts because you want them to continue to grow. One thing with the Roth is that after 5 years, I mean, you have the ability to pull out any contributions that you make, and you wouldn't have any issues in doing that. But again, that would be a very last resort, because we think the value of keeping it in the account will be truly beneficial once you get down the road. And the other thing, as it relates to a Roth, is, let's say you do such a great job kind of over time saving for retirement and everything, and you don't necessarily need to pull money out of the Roth. There's what's called a required minimum distribution for your 401k or an IRA, but there's no required distribution for a Roth. So you don't have to take that money out. I'm getting a little ahead of ourselves here, but I think it's important to have those buckets and to fill those buckets. A couple other questions that did come in around this topic was, one, what is the difference between a traditional 401k and Roth? So what I'm assuming this question is talking about is a traditional 401k and then a Roth 401k. So the difference there is, with a Roth 401k, you contribute with post-tax dollars just like you would a Roth IRA, but it's a company, it's a business plan. So wherever you're working, I mean, you'd be able to defer up to a certain amount of money into a Roth 401k if it's available. This is something you would definitely want to check with your employer on, because there are employers that do not offer this option. I mean, there's different administrative things that could play into it and things. But what you contribute to the Roth portion would grow tax-free, and you can take it out tax-free down the road. With that said, if there is, say, an employer match, those contributions would get placed into a traditional 401k, and those distributions would be subject to tax when you take them out down the road. But there's there's kind of benefit of looking at the Roth 401k option still, because one thing that we didn't really mention earlier is with making these post-tax contributions, um, obviously if you do it pre-tax, you get a deduction. But when young professionals are just starting out in things, they're likely in a relatively low tax bracket. So the benefit that you're giving up now could then, when you say get to retirement age, maybe your tax rate is much higher. Then in contributing to a Roth like that would work out quite well, because you didn't take a benefit now, but you're getting a bigger benefit later because you don't have to pay tax when you take those distributions out. So the other thing, another question that came in was how to decide between a Roth or a 401k, and how do you contribute, and what's kind of the method to the madness there. And there's no kind of perfect answer, but one thing I would say is if you have a 401k at work, a good starting point would be to find out what that company match might be and at least contribute that amount so you're getting the match. Then from there, you can kind of consider a couple different things. One is maybe you contribute a little bit to a Roth IRA. So you're doing some to a 401k, some to a Roth IRA. And again, all this kind of goes back to how much can you actually put in based on kind of what your budget looks like. So I know I've been talking a lot here, but just a couple other things I did want to mention because we are such big advocates of the Roth. For those of you that are listening, it's not too late to contribute to a Roth IRA for the 2020 tax year. You might be saying, well, it's 2021 now, how can you do that? So you're able to contribute up until April 15th. And that is something that, I mean, if you're looking to open one up now and things like that, you can definitely designate those as 2020 contributions. And then once you get past April 15th, I mean, you're then contributing for 2021. So I think those were all the questions related to that type of the types of investing and things. So actually one more that I'm seeing here, it came in, how to invest if you have a large appetite tolerance for healthy risk. So this kind of goes back to what Hannah was saying a little bit about asset allocation. And that's the biggest thing that we try to look at, because if you're young and you have, I mean, you understand the risk and things, what we would definitely advise is you want to go pretty aggressive as it relates to your investing, because you think about it, if you're contributing to a 401k, a Roth IRA, you've got a very long time horizon before you're even going to touch that money. So, I mean, you can be quite aggressive with how you're going to invest that, and kind of whether it's, you could go as drastic as 100% in equities, or maybe something a little lower than that. But the asset allocation is the biggest component of all that. And then you can from there dive into some more of the specifics as it relates to kind of what you're investing in, which I think there's maybe a few questions about that we can touch on at the end. So I'll stop talking for a second, and I'll turn it over to Hannah to start talking about some loan repayment strategies.
Okay, so when thinking about loan repayment and thinking about debt, so one of the things to think about is, what does the interest rate look like? So right now, interest rates are really favorable. So you can borrow money, you can get a mortgage for 2%, 3%. So you're borrowing at a really low rate. So there's not really a lot of incentive to pay that off quickly. So one of the things that we're thinking about right now, and one of the things that we suggest to people, is kind of just pay low interest rate things off slowly. Things like credit card debt, something with high interest rates, you'd want to pay that off first. I think that with the law changes and stuff that's happening right now, a lot of student debt stuff's up in the air. So we don't know if there's going to be debt forgiveness. We don't know when, if in September, when student loan payments go back, we don't know if that's going to get extended to 0% for longer. So there's a lot of different things to think about with loan repayment, and there's a lot of ways that we can strategize with this.
Yeah, so to that point and kind of what Hannah was just talking about, just to make sure everyone that's listening kind of understands, back last year when the CARES Act came out once COVID hit, one of the provisions that they kind of put out was that government or federal student loans, you would be able to delay making payments. And also the interest rate would be 0%. So that would essentially mean you wouldn't have interest accrue during that time. And that went through September last year, and then that got extended. And then just recently, I think maybe last week, they extended that all the way through September of this year. So what that means is, and combined with the fact that, as Hannah alluded to, there's uncertainty over what's going to happen with student loans. I mean, there's talks out there about kind of forgiving student loans. I mean, one thing that Biden has kind of mentioned is maybe $10,000 of student loan forgiveness. So we don't really know anything yet. That's all just been kind of proposals at this point. So one thing that you could consider is if you've been making payments throughout this kind of time where you haven't had to make a payment, that's obviously kind of directly going against any of your principal balance. And if you still have the ability to make some payments, that's something you can do. But one other thing that might even make a little bit more sense is we know that you can defer payments through September at least. So if, let's say, you have some cash that you typically put towards student loans, but you just put it into this, let's say, a savings account for right now, because in the back of your head, you're thinking, well, maybe these loans are going to be forgiven, so why would I go ahead and pay them off right now? So if you set that money aside, and then maybe we'll have some more clarity as it gets to September, and we'll either know, okay, they're going to forgive this these student loans. So all this money that I've been setting aside, I can go ahead and invest or do something like that. Or if they say, yeah, there's no forgiveness, then you've got this kind of bucket of money that you've been setting aside that you can then make a payment before interest starts to accrue again, and be able to really reduce kind of what any remaining loan balance is. Now, there's one big component to that, and that is, if you're setting this money aside for student loans, it doesn't mean you can then go dip into it and just say, oh, well, I think I'm going to go hit the slopes this weekend. I've got this money set aside for student loans, but heck, I'm going to go skiing and I'll use some of it for that. You want to set that aside and keep it there. So then that way, once you get to that point, you can make the decision if you're going to kind of make that payment or if things will be forgiven. So that's definitely a strategy that you can think about here as you go through the next few months. I do want to emphasize that this relates to federal student loans. So if you have private loans, this kind of deferment of payments does not apply. So a couple questions that came in, I think, kind of relate to what we just talked about. One was, should I pay off my college loans? So as I just kind of mentioned, you might want to consider doing something like that. And if another question that came in is it better to pay more than required on student loans or save for retirement? So another good question, and I think it's important to be able to be setting aside something for the student loans until we have more clarity around will anything be forgiven. Because outside of credit card kind of percentages in terms of debt, I would say student loans are probably the next highest thing. So you definitely want to make sure that you're kind of strategizing around that, because I mean, otherwise that interest will continue to accrue and you'll feel like you never can get out from under it. So kind of on that topic too, in terms of credit card debt, um, I know, I mean, young professionals can, I mean, if they're looking to make a big purchase or anything like that, I mean, credit card debt is definitely something. I think last I checked, maybe last year, the average was around, say, $7,000 to $8,000, and interest rates on credit cards are ridiculous. So, I mean, you definitely want to be careful. And when you're thinking about coming up with your monthly budget, I mean, you want to make every effort to, if you have a credit card, be paying that off on a monthly basis, because you don't want that interest to start to accrue. So definitely make sure you're structuring your budget accordingly, so that way that does not happen. So I think those were the only couple questions there. So one thing I forgot to mention at the beginning, there is a Q&A button at the bottom of the screen there that you can enter any questions. We'll try to get to them. If not, we'll definitely get back to you after. And one other question as it came in about investing and kind of what are the maximum amounts that you can contribute in a given year. So for a 401k, for 2021, the maximum that you can contribute is 19,500. That did not change from 2020. And then for IRAs, the amount's $6,000. So for a lot of people that might be listening that are kind of just starting out or anything, I mean, being able to max out your 401k or IRA is likely, I mean, pretty darn hard. I think there's, I mean, to be able to set aside that much, I mean, would be a little bit of a stretch. So you want to be able to come up with what you can put in. So with that said, I think we want to move to kind of the last component here, which is major purchase tips and tricks. So again, I'll kick that over to Hannah to start things.
Okay, major purchases. So two of the main huge purchases you might make in your lifetime is buying a car, and buying a house. So I think one of the most important things to think about, or something that will help you out when you're doing these things, is to create a relationship with a local bank. So usually local banks are able to give you a lot lower of an interest rate than a car dealership or somebody outside. Um, so if you're going in and you're buying a new car and you already have your set loan amount, you have your set interest rate, it gives you a little bit more power, a little bit more control over what you're going to spend and what the car payment's going to look like. That way it can fit back into your budget. Another tips that we wanted to talk to you guys about was knowing your credit score. So a lot of credit card companies, they provide you with monthly reports of what your credit score is, but kind of get to know what your credit score is, get to know what goes into developing your credit score and how to make it better. So be aware of all these things kind of going on and how they impact your credit score and how you might be able to better your financial well-being and get lower interest rates. And then that always just helps your budget. One other thing is that renting is not always a bad thing. So when you do purchase a house and you have this down payment and you think that like, oh yes, everything's gonna fit into my budget. There's always extra costs. There's the hot water heater that goes, the air conditioning goes. You never know what might happen. So until you're really financially secure and you feel like you have a great grasp of your budget, renting isn't always bad.
Yeah, so just a few things to add to that. So as it relates to something like an auto purchase, I can't tell you how many times I've talked to people where they've gone into a dealership or to a car place and basically wanted to buy a car and then kind of went through the financing with them and kind of paid some rate, and they have no idea that, I mean, they feel like they have to basically finance through that and everything. And as Hannah said, that's clearly not the case, because if you kind of look around at local banks or a federal credit union, a lot of times you can get a pretty good rate for auto loans, and it would be kind of even much better than what you might be able to get through a dealership. So it's something that you want to do your homework on beforehand. You want to be able to kind of have that in your back pocket when it comes to kind of talking to them about financing, because if they come back to you and say, hey, we got you a good rate of 5%, and you're able to go back and be like, well, I mean, I I already know I can get a rate of 2.75% at so and so. I mean, you want to make sure that you're kind of knowledgeable about that and you've done your homework, because I mean that can make a pretty sizable difference. I mean, that could mean if you buy a $20,000 vehicle, I mean, you could save, I don't know, $1,500 to $2,000 of interest over the life of the loan. So something like that might not seem like a big deal, but that definitely makes a difference. And as it relates to some of the like the home purchase stuff, as Hannah mentioned, I can definitely speak to this because I just bought a new home last year. You definitely want to, again, this all kind of circles back to the budgeting type thing, because you want to go into that knowing what your budget is for a house. You want to have a price range in mind, because if you say, okay, we've got a range, our high end is $150,000, but you, because of how hot the market is and everything, you're like, oh no, we got countered, so let's go in at 175,000. That will definitely get it then. That's great. You might get the house, but then what do? You had a budget of 150,000. You went 25,000 over that. How is that going to fit into your overall budget? And Hannah also mentioned there's a lot of other things that come into it once you buy a house. There's things break down, and you have to pay for that. I was telling Hannah earlier, another example could be just last night I was out in my driveway shoveling all the snow, and I mean, one thought that went through my head is I should call a plow service and have them come plow, but I'm like, although my back is hurting today, I'm willing to kind of save that cost and do the shoveling myself. So you got to be able to think about all these things. And another thing that is potentially out there is there's kind of a first-time home buyers club. Potentially there are different income thresholds you have to kind of qualify for, and there's a certain period of time that leads up to you buying a house. So that could be a little tricky just because of how hot the market is right now. I mean, there's timing of when you would have to kind of close and things. So that's definitely something, if that kind of is interesting to you, I mean, definitely reach out to us. We can talk a little bit more about it. But I think the other thing that relates to kind of buying a home especially is there's making the down payment, and that home buyers club too can relate to kind of putting a down payment down. Now, a lot of times what you might hear is, oh, I got to put 20% down on the house because otherwise I'm going to have to pay what's called private mortgage insurance, and I don't want that additional cost, so I want to at least put 20% down. That is an option, but what I would also say is, I mean, it's not a requirement. I think the other thing to consider is, I mean, currently the interest rates are so low that maybe you're worth, I mean, you're willing to kind of forgo making a little bit more of a down payment, taking on a little bit more of a mortgage, understanding that that's going to free up maybe a little bit more cash flow for me, because I'm not making that down payment, and I know I'm going to be able to, if I put some money into my 401k, I'm going to get a greater return on that than the, say, maybe 3% interest rate I'm paying on my mortgage. So there's a lot of variables like that that you want to consider when it kind of comes to putting a down payment down on a house and just deciding to purchase a house in general. Because as I said, the market right now is pretty darn hot in Rochester. So especially if you're looking for that first starter home, you want to be very thoughtful, because as Hannah said, maybe it's maybe renting a little bit longer makes sense, so you're not kind of going in over what you want to as it relates to buying a house. So all those things you definitely need to think about and consider. So a couple questions that came in here is, where do I keep the money I'm saving for a house? So this is a good question, because obviously you want to be able to keep that money pretty liquid to then be able to make a down payment and things. So the unfortunate thing is, I mean, if you just keep it in a checking account or a savings account or anything like that right now, the interest rates are very, very low there. So, I mean, there's also CDs, but again, interest rates there are quite low. So, I mean, you're not going to get a huge kind of return on that money that you're setting aside, but it's also good to be able to have that money set aside so you can, when you find that house that you really like, be able to put down a down payment and be able to have a mortgage that fits into your budget. So I think I wanted to try to keep this to 45 minutes or so. There are just a few other questions that did come in. And then I know there's a couple others that came in during the presentation. So if we don't get to them here, like I said, we'll be sure to address them after and get back to you here. So just a couple other ones that came in. What is a good contribution percentage to your 401k and HSA? So we did touch on that a little bit related to the 401k. I mean, you want to at least be kind of taking advantage of that match, and then maybe look to, you can put some more in the 401k, maybe you develop or start a Roth IRA. And then the HSA, so what that is, that's a health savings account. So if you are under a high deductible health plan, you can contribute money to that. And again, it's a pre-tax contribution. But what I would say is, if you're young and healthy, you can put some money away into that account, because that money does grow tax-free. And when you take it out for health expenses, there's no tax exposure. But if you put it in there, it's a lot of times will just sit in cash. So you're not really getting any added benefit there. You do have the option to invest in an HSA, so you could do that, and that would grow tax-free. But so I mean, you can put some into that, but I would definitely look towards doing the 401k, the Roth IRA, and maybe putting a little something in there in case you break your leg or whatever and you have some health expenses there. Here's an interesting one. Assuming I can only do one thing, what is the most impactful thing I can do now to prepare myself for retirement? Hannah, you want to answer that one?
That's easy. The Roth IRA.
So the Roth IRA, again, I'm sure people are sick of it by now, but we're very big advocates of that. So I do think that is an important thing. I maybe to give a different answer to Hannah, one thing that I might say too is, it kind of goes back to the first thing that we talked about, is starting early. I mean, you can see kind of the graphics there of how beneficial it can be to start early. And I understand that, I mean, everyone's situation is a little bit different. So if you, I mean, you can't necessarily, you don't have a ton to put away first thing. I mean, come up with your budget and figure out maybe there is $100 in my budget I can spare to start putting into a Roth IRA. I mean, any little thing definitely helps. So let's see what else there was.
Did you see these in the Q&A, Kevin? So we have, what's your opinion if you want to use real estate as an investment while balancing it and investing in Roth IRA, etc., retirement? So again, this kind of goes back to what we talked about in the beginning. So having these buckets and being diversified. So real estate, especially right now, is a great investment. Real estate market in Rochester is doing great. So yeah, it makes sense to invest in real estate. But again, you just want to be balanced. You don't want all your eggs in one basket. You don't want to get too risky in that way. So as long as you're diversifying.
Yeah, and then another one that came in was, if I haven't altered my 401k contribution rate or any other variables, why would my estimated yearly income goal percentage decrease? Is this due to volatility of the market, policy changes? So I'm not perfectly sure kind of what you're saying, but if how I'm interpreting it is right, I mean, I think a lot of it probably is related to kind of market fluctuations. I mean, if you're putting in the same amount each year, but your 401k is kind of increasing by a different amount or anything like that, then a lot of that is going to kind of have to do with kind of market kind of volatility and things going up, down. I mean, I didn't mention it earlier, but I mean, obviously, I mean, if anyone's been following the news and you see kind of the whole GameStop thing, I mean, that just kind of shows how volatile things can be. And to that point, there was one other question that came in: is if I do have an IRA, how can I what should I be investing that in? So it's a good question, because with a 401k, a lot of times that plan is kind of managed by someone, so you don't have to do any of that work, and there's automatic rebalancing and things. But with an IRA, I mean, you can have someone manage it. That comes with a cost, and if you're just starting out, that might not be something that makes the most sense. So some of the illustrations, the illustration that we showed, if you contribute to a Roth IRA, we're talking all about the Roth IRA. If you put money into a Roth and then you just let it sit in cash, that's not going to really do much for you. You're not going to have really any growth. So you do need to figure out what you're going to invest it in. And there's different things that you can do if you're just kind of starting out. I mean, there's different mutual funds that you can pick. There's target retirement funds that you can pick, just something so you get it invested, so you're starting the clock so it can grow. So if you have other questions as it relates to that, I mean, we'd be happy to talk to you. But you definitely don't want to just keep it in cash. So I think, let me see if there's anything else here.
And then just to add on to that, when you do invest and you pick an investment strategy, an important thing to remember is to stick to that strategy. What you don't want to do is be like, yeah, I want to be real risky this year. And then when things kind of go not in your favor, you don't want to pull your money out. That's really going to hurt you. So as long as you stick to your investment strategy and ride out any downturns, that's going to be the most beneficial.
Yeah, great point, Hannah. So again, I wanted to keep this to 45 minutes to 50 minutes. So I know there's a couple coming in still, so we will definitely kind of get back to you here. This last one that came in assuming I'm meeting my employer's 401k match and I want to invest more in retirement. Should I save more in the 401k or max out a Roth first? I think there's a lot of benefit to putting money into the Roth, because especially if you're in a pretty low tax bracket, you're foregoing a deduction that, I mean, is a pretty low rate. So I do think building that Roth makes a lot of sense, so you can keep building those different buckets. But as I just said, I mean, you definitely want to then be investing that money that you're putting into a Roth, and then coming up with kind of whatever makes sense from your budget perspective. So with that said, I'll kind of wrap things up here. Again, if anybody has any follow-up questions, we are happy to connect with you and talk more about this type of stuff. We can also talk about some other things that we can even help you out with as it relates to kind of your specific situation. So I think our contact information is on the last slide. And if there's any questions, I think you may, in the email when you registered, you had our contact info. Again, don't hesitate to reach out to us. And on behalf of Hannah, I'd like to thank you all for coming today, and hope to talk to you all soon.